let's turn attention to Tollens Tires, and this is one of the leading names that we are seeing in procured trade rubber and tires for commercial and agriculture vehicles. But before we get to the management, let me bring across Puneet on board to talk to us about the company, what the company does essentially.
Well, thank you for that. It's a very interesting management to say the least, because it's operating in the tire space. For almost 65% of the company's revenue comes from retreaded tires. That essentially means older tires which have lost, the strength of those tires have been lost, and they reapply the tread, and that's where the PTCR venture which is mentioned on the screen right now comes from. Largely operating in the new tire space, roughly 35% of the company's revenue comes from there, and that's largely operating in LCVs, agricultural vehicles, as well as 2 and 3 wheelers, so still not present in the 4-wheeler space. But the interesting part is that the management is looking to increase their share from new tire space specifically over the next few years, and that is one of the key aspects of the conversation. It is a recent listing, has done decently for us investors, but over the course of the next 3 to 4 years, the company's share of business could change substantially, and this conversation largely looks to get some more perspective of what the business could look like, at least in the medium term.
Okay, just on that note, let me get the management on board, and we have Shankar Krishnan Ramalingam, the whole-time director, joining us. Hello and welcome to the show, sir. I want to start off this conversation by asking you about the current mix that we are looking at. This is in terms of the new tires mix as well as the PCTR segment that we are talking about. Just want to understand the contribution of this going forward.
Thank you so much for having us and giving the company the opportunity to present to you large globally through your media. Thank you so much once again for the same opportunity. Basically, the company started originally as a retrading manufacturing component company way back about 40 years ago, and predominantly till about 2005, it has been 100% on retrading material and about with no new contribution on the new tires. 2005 is when we started getting into the new tires manufacturing facility. And it started with about 100 tires per day over a period of time, till such time that by 2023, we acquired a plant in Cochin and increased the capacity from 100 tires per day capacity to about 5,000 tires per day capacity. So there was a huge jump. So prior to the public issue in 2024, the company had ensured that through the promoters' infusion of money, that there is enough and more substantial expansion of capacity expansion that has taken place which will suffice and meet the demands of the industry for the next 3 to 4 years of time. So currently, from about 100% what we were about 10 years ago in terms of only contribution from retrading, we have now come to a mix of almost about 60% to 65% in retrading and about 35 to 40% in new tires. And new tires, again, we started only with 2-wheelers, then we progressed into 3-wheelers, and then we got into LCV segment, and then we got into agricultural tires. And very recently, about a month ago, we have also gone into a wide range of agricultural tires is what the new expansion that we have got into. This is exactly where we are at this point in time in terms of the product mix.
Mr. Ramalingam, good afternoon, sir. Thank you for joining in. It's Puneet this side. Largely, where does your current capacity utilization stand for your tire space? Because it's still roughly around 30 to 40%, but where do you expect it to go? Could we see that it could reach roughly between 75 to 80% maybe in the next 3 to 4 years? And subsequently, will that mean that your revenue could go with somewhere around 50% each from retrading as well as the new tire space?
I think you're absolutely right on dot in terms of both the timelines, in terms of the product segmentation as well as the capacity utilization. See, this is basically capacity utilization largely depends on the availability of the funds in terms of the working capital management. And this industry is a very highly working capital intensive industry. And the turnaround ratio, if you look at the last 5 years balance sheet, of course, we have made humongous efforts in terms of improving the ratio, etc. And we are still continuing to be in that path. But being a working capital intensive, it's basically the availability of money, and that will take care of the capacity. The demand supply is very much in favor of the industry at this point in time. And with Chinese imports being there, both in India as well as in Europe and US. So a lot of large players are taking advantage of the whole scenario in a much better way with better realization. So right now, it's a suppliers, manufacturers market is what I would probably categorize them. So given the internal budgets and the availability of internal accruals, getting back into working capital and having raised some money through IPO in terms of the augmentation of working capital, having become debt-free as a company, I think in about 3 years' time, we should certainly touch about 70% of the capacity utilization. And in terms of volumes, probably we'll grow more. And in terms of the product segment, I think we will be somewhere 50-50 or about 45-55 in favor of new tires.
Right. So say,
Because we are expanding the new portfolio of new tires in a big way.
right, sir. So say, sir, over the next 2 to 3 years, as you were mentioning that it's a manufacturer's market. So over the next 2 to 3 years, what is the kind of revenue growth rate one should expect from Tollin Tires, and how are the EBITDA margins looking like?
Mr. Puneet, I think Tollins, right from the IPO days and the roadshows and the investor earning calls on a quarterly basis, have always, not given out the kind of guidances and things like that because of the extraordinary amount of geopolitical situations and because of which the volatility that happens in the crude prices, which makes way for the raw material like natural rubber and synthetic rubber and those kind of things to keep moving in a very volatile fashion. So we don't normally give out guidance, but I think the company, if you see the track record of so many years, I think has been consistently growing on a lower base earlier at about 35 to 40% CAGR minimum. And so we are very comfortable wherever we talk in saying that about 20-25% CAGR is something that we would maintain very comfortably under good and bad conditions, both put together and in spite of the raw material movements, etc. So that's exactly where we see. And however, in terms of the profitability, I think we are much better placed because of three key factors. That one, we have a wholly owned subsidiary from which the raw material components are secured. So there we have a very good profit profiling that happens. We have a unit in Ras Al Khaimah in UAE, which is, I believe, is the only unit in the entire Middle East and Africa in terms of the retreading material that needs to be manufactured. So the focus is more not only on adding new product ranges, new penetration of geographies, but also keeping together intact the profitability margins. We have always guided in every investors meeting that probably the company would clock in a range of about 17 to 20% in terms of EBITDA and about 10 to about 11.5-12% in terms of the PAT.
Sir, recently there was a big GST rate cut for tires as well, from 28% to 18%. Obviously, this does not mean that the demand will boost in a very big way, given the fact that tire demand is largely inelastic, I believe. But any issues that you're facing with input tax credit here?
There are little areas of concern. I wouldn't say concern in terms of the clarifications that are needed, and both the tire association as well as the retrading association, we have got a huge relief in terms of coming down from 28 to 18% in tires overall in terms of two-wheelers, three-wheelers, LCV, etc. Agriculture, we have been able to get to a place of 5% from 18% earlier. Retrading is one thing which continues to be at 18%. And we feel that retrading industry is an environment-friendly industry. And for a developing economy like India, retrading is extremely important. And more so because there are very few organized players in India in the retrading market. And largely the market is dominated by regional players and unorganized market. So the retrading association has taken up the matter. And the retraded tires give 60% cost efficiency and almost the equal longevity of time as good as a new tire. So, and environment friendly, green. So given all these factors, the industry has made a representation to the government to lower the retrading material product manufacturers from 18% GST about 5% GST. So let's see how exactly it pans out. But the current move by the government is extremely consumer friendly and industry friendly. And this is something that is very welcome by the entire industry. And given the current scenario of the GDP growth and how India as a country is positioned, so we see the margin profiling also getting into a little higher notches in terms of these policy decisions by the government, not only driving the volumes.
Mr. Nangalam, just a final couple of questions from my side. How are you actually selling the new tires? Is it more that the business is now moving towards B2C because you have to go to the consumer, or are you doing a distribution model? That's question one. And secondly, on your agri tires, these require huge molds, a lot of technology to manufacture and get those molds right as well. How have you actually developed that? Because you mentioned you entered into the space very recently. So if you can just give us some perspective on that, sir.
So first point on the business model, I think traditionally over the period of several decades, Tollins has to be originally started as a regional player and then start penetrating geographies in the interest in the country, and have gone into Punjab and Delhi and Northeast and Bangalore and we have started putting our footprint into Andhra Pradesh, etc., which is why 85%, 90% kind of a regional player domination in terms of revenue till about 4 or 5 years ago. We are almost at about 50-50 in terms of the within Kerala and the rest of the country. Now, in terms of the business model, we have always followed the dealership model. We have about 3,727 dealers across the country, and these dealers have been with the company for pretty long periods of time, and we have a very well entrenched relationship with these dealers. Plus, we have our own depots strategically positioned in 8 different locations in the country in terms of having an efficient supply chain and logistics pattern. So this is our basic business model. Our OEM contribution on the whole revenue is not beyond about 7.5 to 10% on the overall revenue. Whereas if you see the peer comparisons, most of them in the retailing market at least is largely dependent on the state transport undertaking tender business, which is a very tricky business. You will get volumes, but protecting the margins, etc., will be extremely tough when there is going to be excessive volatility in terms of the raw
On that
material.
margin part, I want to understand. In Q1, we did see that margin pressure building on. We've seen, you've had a 19 to 20% of a margin, which has now declined to 14%. So just for FY26, want to get that final number in place, considering, raw material cost, there was not a significant change, but it was the other expenditure where we did a higher increase in terms of where the percentage was.
No, during the first quarter, we have got into some strategic relationship with Apollo Tyres, where we have created a dedicated facility for Apollo Tyres on a white labeling contract manufacturing for them for the entire their requirements under their band, Durolite for the retailing material. In fact, the first quarter did have an impact with regard to the raw material prices going up in the market by about almost 10%, which is why across the industry, whether it is JK Tyres or Apollo Tyres or CA Tyres, everybody had gone through a correction to the extent of about 750 basis points in terms of this thing. So whereas we could restrict that correction to the extent of about 300 to 400 basis points with the additional investments and creation of infrastructure, etc., having happened for Apollo Tyres. And if you're looking for margin visibility in terms of this year, I think going forward, the next second half will be extremely good. And by the end of fiscal 26, I think the margins that we had topped up in March 25, we would have certainly reached that because of various initiatives. Yeah.
Right, sir. Well, thank you, sir. Thank you for joining us and explaining your and thank you for explaining your company so extensively.